Welcome to SNN.Network Summer Virtual Event. We are pleased to introduce the next presenter for today's event, Ghassan Halazon, founder and CEO of EMERGE Commerce. Ghassan, the floor is yours.
Well, thank you very much, Rochelle. It's really good to be here with everyone. I really appreciate your time here today, this morning. My name is Ghassan Halazon. I'm the founder and CEO at EMERGE Commerce. We are TSX-V ECOM, an acquirer and operator of direct-to-consumer brands across North America. We have about 2 million subscribers that we present over 12,000 merchant partners, offers to ranging from premium meats to groceries, golf experiences and equipment, family activities and events, and nearby escapes. We count a number of reputable brands in our portfolio. Our most recent acquisition is trulocal. It's the market leader in meat subscriptions, $20 million plus revenue business. It's profitable, it's bootstrapped, and connects local farmers with a health-conscious, digitally savvy audience. Under par and JustGolfStuff are our golf experiences and equipment brands. WagJag, we acquired from one of Canada's oldest media companies called Torstar, parent company of the Toronto Star. It is a family voucher portal. So these are just some examples, but overall, we look to acquire these businesses, plug them into our universal engine and playbook, and ultimately help them cross-sell and gain advantages of scale that aren't available to any of them on their own. So talking a bit about sort of e-commerce positioning, it's hard not to mention the big gorilla in the room, Amazon, retail juggernaut, $1 trillion plus player, but and then they're an all things to all people store, and that's here to stay for the foreseeable future. But on comes along Shopify and really sort of these cool e-commerce enablement technologies, and they ultimately come in and start equaling the level playing field for a concept they call arming the rebels. In other words, they're creating this ocean of opportunity of small to medium-sized businesses in e-commerce that conquer their own niches, whether that's jewelry, whether that's pet products, whether that's supplements. So really this emergence of all these smaller players is the opportunity that EMERGE is tackling. In essence, we come in and we acquire rockstar rebels. A bit about sort of the company and our background as management. I've been in the e-commerce sector for north of a decade now. Been involved in everything from bootstrapping, acquiring, selling, restructuring e-commerce assets. So for us, EMERGE has sort of been a second coming of sorts in pouring our relationships, our mistakes, our experiences and relationships, all of that being poured into what we believe is a smarter way to scale e-commerce through acquiring rather than building from the ground up. Jonathan Leong, our CFO, comes from, he was the original CFO at Afria, comes from a private equity background as well as multiple go publics under his belt. Fazil, our COO, sold Snapscapes to Groupon a while back and is essentially one of the original operators of the initial company that we acquired called Bytopia. George Marucos from Dye & Durham, $3 billion legal software rollout, terrific addition to us to give us M&A strength. And alongside him, John Kim, one of our independent board members that came in and from Well Health Technologies, also a multi-billion-dollar health tech rollout. So a bit of sort of a pro forma view on the business. We're at $49 million gross merchandise sales business last year. About 29 million of that we count as IFRS revenue, i.e. our take rate. Adjusted EBITDA positive is something we're especially proud of, 2.4 million run rate last year. And again, now majority subscription revenue through the trulocal subscription box. We don't offer guidance, but we do sort of look closely at what analysts are projecting and share that with our investors. As you can see here, this is the guidance and the consensus coming from Canaccord Genuity and Raymond James. So we doubled revenue last year, and we're expected to more than triple it this year. Obviously, last year was a big year for us, becoming adjusted EBITDA positive. for the first time, and we expect that trajectory to continue. Research consensus has us at $2.18, and from our perspective, I think they've done a thorough job of getting a sense of all the moving parts in our model. We're obviously in the business of under-promising, over-delivering. We believe this is a good baseline, but doesn't really factor in the explosive acquisition pipeline that we're about to take advantage of. So we're very excited, and we think what they've looked at and what they've portrayed here is, a very respectable business. So speaking of performance, we haven't announced our Q2s yet. We announced our Q2 results on August 30th. But this is sort of our most recent quarter, Q1. As you can see, we more than tripled revenue from $2.2 million to $7.1 million, up 223%. Fifth consecutive quarter of positive adjusted EBITDA, north of $20 million plus in cash following our $12 million raise in March. So we've been very active since going public, and we've made some great additions both to team as well as getting the recognition from research early on. So really well positioned here now to deploy the capital and execute in a big way between now and year end. So bit of history on stock price. We've consistently been able to raise capital at a higher valuation than prior rounds. We've never had a down round. We've raised $31 million in total equity capital, but keeping in mind we still are sitting on $20 million plus. So we've been highly efficient in capital allocation and making sure that at every juncture, whatever capital we've raised, we've deployed it towards an accretive acquisition, in many cases larger and more profitable than the one before it. So we're most excited now about the fact that we have more cash than we ever had before, and we're about to start tackling bigger and better acquisitions in the near term. So next slide is just talking a bit about some of the boxes we've checked through this year that we're very excited about sharing. We've talked about this, so I won't rehash here. A couple of key things ahead. Firstly, more and more so we're becoming a debt-driven company, so we're having, and frankly, becoming adjusted EBITDA positive, seeing the growth that we're seeing the pipeline of profitable businesses that we're around. It's finally starting to make sense to scale up debt to about 3 times EBITDA and really leverage that debt to minimize dilution and to continue to roll up profitable assets. So that's going to become a bigger part of the equation. We do not foresee any short to medium term need to tap the capital markets. We don't have any plans to do so. For us, we have the cash, we have access to debt at very affordable cost at this point, and we're very excited about that combo. And then we're looking to complete 2 to 3 acquisitions here this year, the remainder of this year. That is, our last one was December 31st. And so we're really lining up a very exciting 4 or 5 months here to wrap up 2021. And as I mentioned, trulocal had tripled our revenues, but we're about to do some pretty big things from our perspective, and a lot of planning is going into this next phase now. So just chatting a bit about sort of M&A and our philosophy and our pipeline. As you'll see, our general focus is on organic, positive growth businesses that have sticky market positions. And we love bootstrap companies and founders like trulocal, and we'll talk about their profiles shortly. But, overall, we find this $1 to $5 million EBITDA range as a sweet spot for us, and our target acquisition multiple is typically 4 to 6 times EBITDA. So obviously we're taking advantage of that public-private arbitrage. And overall, we're pushing more and more cash and deferred than performance-based and minimizing the equity side of the formula here in the short term. And we think that, again, over time, we want to really focus on minimizing dilution and doubling down on cash flow. Talking a bit about our pipeline, obviously we have a dedicated M&A team that's only scaling. We've built out our relationships both organically as well as through the brokers, our banking partners. So really sort of building out this ecosystem of multiple opportunities. And so for us, I think part of what we're looking to get to here is we built a $68 million EBITDA pipeline from 15 live opportunities. Obviously, we have a bigger overall pipeline than that, but really zoomed in on the ones that we're in and around the LOI phase, as well as into deeper dive due diligence. As you can see, subscription portfolios, wellness, golf, organics, foods in general is a big category with truLOCAL now. These are all terrific high-growth e-commerce categories, and the most exciting part of the slide is the fact that these businesses are profitable. If you looked at this sort of thing 10 years ago, Amazon was the beast, and there just was not these smaller profitable businesses. It's really the rise of Shopify and other enablement technologies that have really influenced and enabled these small to medium-sized e-com companies to actually cash flow. And that thus is the opportunity that we're tackling here. So this is all pre-synergies, very exciting stuff. Let's take a quick look at the truLOCAL profile, because I think it's indicative of those hidden gems or those rebels that we're going after. This is a profile of a business that scaled from 0 to 20 million with under $1 million in equity capital invested. So a phenomenal operator and team. They joined us entirely back in January. The fact that they have an incredible brand, impeccable customer reviews, proprietary merchant suppliers, all of that added up to this. I mean, it's not just, hey, this is a growth business and it's even a profitable business at an early stage, but it's also just the intangibles and the brand equity that these guys have built is phenomenal, and they're poster child for future acquisitions. So you might ask, well, what are some of these things that we do when we acquire a company? How do we add value? And really the next two slides kind of talk about this stuff. So firstly, after acquiring a business at, a 5 to 6 times EBITDA multiple, let's say, we tend to bring all of our brands under our umbrella. Now, we keep the brands, but we help them save costs and share in resources, and effectively we take care of the pipes, if you can think of it that way. So everything from marketing to email costs to customer retention to security, these are all themes and things that our dedicated HQ team helps everyone with. So admin, customer service, payroll, all of the boring functions, as we call them, these are things they don't need to worry about too much. They get to focus and double down where their expertise is at. The second aspect to this is sort of how we accelerate these businesses, right? So essentially think of it this way. If you are a meat lover, you might very well have a propensity to buying wine. If you love golf, you may love, a staycation or an adventure, in nearby or sort of, or even abroad, right? So a lot of these relationships are formed in our database, and we get richer and richer data with every added acquisition, and that's another chance to monetize businesses beyond the shopping cart. We also specialize in M&A, obviously, and so therefore we offer these sort of bootstrap businesses that join us the opportunity to consider tucking in or rolling up consolidating their space. So these are some advantages we pass along, obviously, and again, we just get smarter and bigger and better with every added acquisition. Other examples include, for example, when we acquired Underpar, the golf business, it was only in Ontario and California, but through our sales team and through our systems, we were able to sort of launch another 8 markets. Those include Florida, Texas, Illinois, the Carolinas, and various others. So from our perspective, that's a very important advantage that we bring, because I always say what took you from, sort of 0 to 10 million isn't exactly the path that's going to take you to 100 million, right? And that's the vision. That's what we're looking to achieve here. Every brand, ultimately every vertical, whether that's golf, whether that's groceries, whether that's pets or otherwise, all of those verticals, we want to see $100 million opportunity each, and ultimately a multi-billion-dollar opportunity at scale. Effectively for us, we think that's a tiny drop in the bucket of the $4 trillion e-commerce market out there today, which is obviously expected to double and triple as the years go by. Bit of a corporate update that we'd like to share, we shared in June that I think, gives you a glimpse. We're about to announce our Q2 results, as I said, August 30th. We kind of looked at some of the key divisions. One of the biggest questions, right after I think the pandemic started to wind down to some extent, was what would truLOCAL, meat subscriptions and grocery, what would that all look like there was, a sense that the pandemic heightened, those levels, and that they would just go back to pre-pandemic. Well, what we shared was that, we're well into it now, and as of June, we haven't given any guidance since June, but as of June, we were seeing at least 2x pre-pandemic levels. So we're kind of sticking around the normalized levels. There was a certain period in time, obviously, last year where things really went crazy and sales just skyrocketed to, points that for a week or two, we would have never imagined them to stick ongoing anyway. But since then, and since everything's normalized, we're still at 2x pre-pandemic. With obviously that comes with improved profitability, and just sort of online grocery, in our view and in PayPal's view, as you can see here, is going nowhere but up. We've also sort of started to think through the golf business's next iteration. We're seeing a lot of potential. As you know, the sport of golf has received tremendous amount of interest in newcomers and demographics, both young and old, as well as female and male. And so it's really sort of been a rejuvenating situation for golf. And, for us on the product side, that's only meant triple-digit growth. On the experiences side, we continue to sort of think through supply and demand. And one of the unintended consequences of everybody playing golf is that some of these golf courses don't necessarily need to use us for inventory or for discounted inventory in specific. So there's a lot of iteration, a lot of innovation happening in golf, and a lot of potential M&A as well. But we're very excited about the overall opportunity of continuing to lead and open up new verticals based on our 300,000 plus golfers. And then just in terms of our local and travel businesses, which is really sort of experiences and events and activities, that's really finally started to see the light after being so quiet for a year and a half. And sort of June was our strongest sales month all year. And we're expecting that, this second half of the year and into sort of Q4, which is the biggest time of the year for online shopping, we're expecting some, really positive results to continue. And I think that's a good potential business as well that's been quiet despite all of our growth. We've seen, as I've shared before, we've more than tripled revenues in Q1. Analysts, they're expecting us to triple revenues this year, excluding future M&A. So we're in a really good spot. We feel, our verticals are diversified enough to give us, the ups and, sort of level out the ups and downs and really just continue to help us see that triple-digit growth overall and low double-digit growth organically is I think what we're zooming in on and what we're aiming for. I'm just going to talk about one more slide, just to sort of, highlight the data aspect of our platform. And so basically, you have this engine, right? From our perspective, a lot of times you think of e-commerce as just selling and buying online. But the reality is what's happening behind the scenes is that we're collecting, a tremendous amount of rich, high-quality data. And for us, what's most important is the correlations we're building between the brands and the cues that we're getting out of it, right? So essentially, I'll give you an example. When the pandemic hit, we essentially found ourselves in a unique position where we could tell from the searches on the site, from the inquiries on the site, that a lot of people were looking to deliver groceries and deliver meats. And so we asked ourselves, who's number one in grocery in Canada and in meat specifically, because that's the opportunity that I think we can, identify and go after. And the answer was truLOCAL. And so we got to know them and we loved everything they stood for. And ultimately we acquired them, as I mentioned. And that's just been a terrific experience for us. And we would not have been picked, if you will, to that had we not had these other assets. So we're kind of sitting in the middle of consumerism, and we're really getting a pulse of, what consumers are shopping for, where they want it, at what price they want it. And that data is really sort of the holy grail beyond the shopping cart to get that value and to build up that profit margin in a way that most e-commerce companies have not been able to deliver to date. So I'll end on that note and take any questions at this point if anyone has them. I think from our perspective, just to sort of recap here, EMERGE is about to be very aggressive on the M&A front. We've completed 5 acquisitions to date. And we're building up the M&A bench strength and the corporate finance side of our business and finance and accounting units to really propel us to a position where we can be upping the ante on acquisitions. And we have multiple signed LOIs, and it's something that through our last fundraise with having $20 million on the balance sheet, we feel that, it's a good time now to really be acquisitive. As I've said, the guidance we've given is, 2 to 3 acquisitions over a 12 to 18 month period. Well, we really think that the next, between now and end of the year, there's a chance to, complete at least 2 acquisitions. And we're really pushing hard to make that happen and take this business to a whole new level. So with that, I'll jump in and see if we do have any questions. I do see one. What would you say is the primary external catalyst that you think would be a major inflection point for EMERGE? Well, I think, from our perspective, that as I was just speaking here last, was, we've raised this capital, the business has shown some really solid metrics, and we're now in a position to deploy the capital cost effectively with the capital allocation discipline that we've shown in the past, only bigger and more profitable. So for us, building up our EBITDA levels to let's call them institutional ready or institutional friendly levels will be a big deal to prove that we can not only buy small businesses but increasingly larger and more profitable ones. I think the other aspect of that catalyst is going into the U.S. A lot of the acquisitions we're making are in the U.S., and that's just opening up the doors to a lot more possibilities with investors and other partnerships. For us, we're not here to be sexy. We're not here to burn through cash. Like, our objective is very specific, is very disciplined. So we look at the Berkshire Hathaways and the Constellation Softwares of the world, and there aren't many, that really, really stick to these principles of staying lean and mean and really focusing on cash flow rather than on empty calorie growth for the sake of growth. So I think as we prove that out, we got to show that those levels of EBITDA, 5, 7, 10 million EBITDA, I think that'll start getting a lot of attention for us. And research analysts started looking and waiting to see how we're going to deploy this capital. So we're very excited to showcase, the new team, our efforts, our pipeline. All of this is coming together at the right time, and we're very excited about the second half of this year. Obviously, it's already underway, as well as sort of the next 3 to 5 years as we build out one of the few multi-billion-dollar e-commerce consolidation plays. That's sort of our belief and our hope, and we hope you continue to watch and join us on the journey. Okay, thank you, everyone. That's all we have for here, and appreciate everyone's time. TSX-V ECOM. We report our Q2s end of this month. Look out for that, and look out for all of our M&A and growth plans ahead, as I've outlined. Thank you.
Ladies and gentlemen, this does conclude EMERGE Commerce. Thank you for joining. You may now disconnect.